Financial Officer. Thanks for taking the time to come in. As a reminder for anybody who doesn't know me, my name's John Worston. I cover the large cap integrated and services companies for CIBC. Really appreciate you coming in to do an update with us. Just as a reminder to the audience, we're going to try to keep it as interactive as possible. So throw up your hand, ask a question. If you want to use the app, that's another way to get it in front of the company and get your questions answered. So by all means, please use that. Jeff, thanks for coming.
Thank you.
I guess maybe as a starting point, just at a high level, how should we think about Husky in a 2020 perspective? Maybe talk about some of the top priorities, what you would like to accomplish this year, and maybe what we should see out of the platform, kind of independent of the macro oscillations that are going to be inevitable over the coming year.
Yep. Good morning, everyone. I'll start a little bit with where we've been in this past year and what our focus is broadly before diving in on 2020. Number one, it's all about execution and delivering on our commitments to the market, on our controllables. And we saw when we went out with guidance, in particular, we're focused on our safety performance, which ultimately drives solid operational and financial performance. We're continuing to focus on driving down metrics on TRIR, Tier 1 safety events, and ultimately the operations will deliver the cash flow we intended. And if you look at where we're focusing our capital frame, we did reduce our capital investment profile for 2020. And where we're focused on investing now, and we're investing in around $3.2 to $3.4 billion is what we've outlooked for 2020. And that focus is really on driving margins in our two businesses. In particular, in the integrated corridor, the majority of our capital is focused on our thermal developments in Lloydminster. On the Saskatchewan side, we have two thermals coming on this year in 2020. Two Spruces, Spruce Central and Spruce North. They come on mid-year for the East, or Central, sorry, and North comes on around the end of the year. And really it's focusing, and we've, delivering those on time, on budget, and we have a good track record with those. We brought on Deep Valley this past year in 2019, actually ahead of our original schedule, and we hit our nameplate capacity within a quarter. And we expect the same performance out of the next Spruces. So that's 20,000 barrels a day we're focused on bringing on, which really is a feedstock source for our upgrading and refining complex in Canada and the US. And the remainder of our capital is really focused on our offshore developments. And it's not about growth it's really about driving value out of the infrastructure we already have. So if we look at the Atlantic region, our investments are focused on obviously the West White Rose, which we are seeing very good productivity now, and we actually poured a 4-slip quadrant this year ahead of schedule from where we thought, and ultimately basically for the price of 3. We're seeing very good productivity. We expect that project to come on in around the end of 2022. So what that will do ultimately is leverage all of the FPSO, the subsea infrastructure on the existing White Rose and Sea Rose. So really looking at getting the most out of our cost structure, getting the margin enhanced, because it's really a fixed cost game in the offshore. And then when we turn around to Asia, our focus really is the 29-1 field. And again, that ties into our Liwan development and infrastructure. In 2019, we completed all of the wells. We're now focusing on tying in, doing the flow lines and the like, and we expect that production to come on around the end of 2020. And so really what it is delivering the capital program, diluting our operating costs, getting the production out of the facilities in our core areas, and sourcing feedstock for our US refineries. And then really what long-term it's about out of this is balanced growth. And what that means is inflationary growth, really with the focus on enhancing margins. And when I talk growth, I mean margin growth, not headline production growth. And returning cash to shareholders is the priority as we expand those margins. And we really see that pivot point in 2021. 2020 is really a key execution year for us, and it's delivering those thermals, 29-1, and continuing to execute on the West White Rose. So look at us as execute and deliver what we say, and deliver on our promises and deliver safely.
Perfect. When you came out with your capital budget in December, you had shaved CapEx off, both for 21 in a more meaningful way, but 20 as well. What gave you a level of confidence to assume that you're going to be able to do that and meet the plan where in May you weren't confident in running with a lower CapEx number?
Well, I think it's on on a continuum, and we're continuing down to focus our capital. So the guidance is 3.2 to 3.4. We've got about $1 billion or a little over $1 billion really going into our thermal developments in Lloydminster, whether that's the spruces or our sustaining pads in that area. We've got $1 billion going into the Atlantic, and really it's focused capital, and then the rest is really your ongoing capex in the refining space. And the capex in the refining space is now just what I'd say is your base turnaround capital and the like. We've invested to enhance our kit on the feedstock. The last piece we have in the downstream, if you say, is the upgrader, and we're basically looking to double up our diesel capacity at the upgrader. And we have a turnaround this year on that. Once you're through that, it's really just continued execution. And so really the rest of it is, if you look at where we've cut back capital, is price signals and focusing the capex. So we cut back in Western Canada with with Western Canadian gas prices, although they're interestingly up in the near term. I don't see us, we're not going to look to allocate capital there. I think long term, we see the price signals there. We cut back in that area in the drier gas in the Ansel Wilrich. And then we also cut back what I'd say is on the longer term growth in the Atlantic and the longer term capex. Looking at the price signals and the long term forecasts, we've cut back any kind of future development or exploration capital there. So it's really a factor of price signals, focusing the capital into even what I'd say is more core areas, and really just focus on driving the margins out of our core assets, which is really the Lloydminster block down to the U.S. refining and getting the most out of our offshore assets.
Does the forward path for curtailments have any meaningful impact on how you think about allocating capital? Because obviously in Saskatchewan, you were never curtailed. It obviously has an impact on maybe downstream profitability, depending on what's going on. But again, you're physically integrated. So although you're philosophically opposed to the curtailments, if they were to come off tomorrow, would it change how you think about capex in 1, 2, 3 year increments?
And short answer is no. Where our capital is focused is, our highest returns in Lloydminster, executing the West White Rose project. What we have in Alberta, and we are in multiple jurisdictions, but we have in Alberta Sunrise. And it would be just continuing on, your sustaining capital there, drilling your pads and looking at, potential opportunities, whether it's NCG and the like, but we're not going to materially move the capital there. We'll focus our thermal or in situ focus in Saskatchewan and continue to do that. And curtailments is kind of inconsequential to that. I don't think if they lift, we'll be materially moving the capital. And the other, what I'd say is material asset on the oil side in Alberta is Tucker. And we'll continue to run that around, around 25,000 barrels a day. We're not going to look to debottleneck or anything like that. I think it's just continued just to run the assets, fill the plants, and go from there. And then on the gas side, back to where I said is we're not bullish on long-term gas prices. We cut back capital there, and I don't see us really refocusing on that. So our capital frame is set, and that's regardless of the quota system, really. And we'll continue to focus where we are, which is in the Atlantic offshore, and 29-1 and the thermals.
Maybe an update on the retail divestiture. Prince George came together. I think you were very happy with ultimately how that played out for you guys. Retail's taken a little bit longer than maybe you would have thought. Any update on what's driving the extended duration, and whether your appetite to sell has changed at all at this point in time?
I'll start with the appetite. Our appetite is still to sell the assets. We're well advanced in the process. I think you go through this and you compare something like Prince George to a retail and commercial fields network. Different assets, different complexities and nuances. And you look at the retail space, commercial fuels. There's commercial complexities, things you have to work through. But we're well advanced. I think we have a competitive process, and we'd look. Depending on as you go through and the counterparty and the reviews, I'd say, looking to have, closed by the latter half of the year or the back end of the year. But, we're still committed to that, and we have, I say, a good competitive process. And yeah, you'd always like it a little bit earlier, but, we've got to work through all of that. But we're in a good place, and we're happy, generally with the value. We're happy with the values we're seeing. Okay.
And is it fair to assume that all of the complexities to it is probably in relation to who we would assume to be counterparties, and that some of them have overlapping geographic concerns, and all those types of things would be the largest challenges?
That would be part of it, absolutely.
Okay. Capital allocation, obviously we're in an environment where everyone wants to see an immense amount of prudency around spending money, and the push to every company is give as much of it back to us as humanly possible, whether that comes from a dividend growth, a buyback. anything along those lines. Sitting in the CFO chair, how do you ultimately think about what is sustainable when you're running a cyclical business, like calibrating the dividend? How do you ultimately go, this makes sense from a long-term sustainability perspective?
Yeah, and I'll start with just my long-term view of the business and how I think about it is we talk about a balance, and so what that really means is making sure that we don't starve the business. We're not here to really grow it. It's just to make sure that we continue to enhance margins and get the most out of the kit, and that's where you've seen our investments go, whether it was the crude oil flexibility project or the thermal development Saskatchewan, which is lower cost than in replacing higher cost CHOPS production to feed that refinery complex. That's what it's really about. And what you need to do that is that has to be within cash flow. And it ultimately has to grow margins to provide a platform to grow returns to shareholders. So number one is we're not in the headspace of actually increasing the capital frame or the CapEx program. I think that is set and we'll execute to that. And if I think about balancing returns to shareholders, obviously we are in a cyclical industry. And what we've done in the portfolio is to take some of that away. So if you look at it as the integrated corridor really isn't exposed to the Canadian differential at all. We do go a little long exposure and have higher production than processing or export capacity, by the end of the 5-year plan. But that's really on the margins, is to keep that balance, take that risk out of the system. And then if you look at the offshore, a good chunk of the production is really out of Asia Pacific, whether it's Indonesia or off the south of China, largely fixed price gas contracts. So it eliminates some of that volatility, and that was purposeful in how we constructed the portfolio. So that provides a dividend, a capacity to actually base a dividend off. And I kind of in my mind is anything has to be sustainable in the 50s on a TI basis, give or take, right? And we don't target specific payouts, but that's where we'd be, and we'll triangulate that to where our leverage targets are. And we're currently, around $4 billion, if you look at where we were in Q3. Mm-hmm. And, and if you do our 2 times, FFO, it takes you to around 4.5 on a ceiling as we continue to enhance margins. So, you've got to keep that room on the balance sheet to make sure you've got a shock absorber. We've taken risk out of the portfolio. And where we have windfall profits, or you have higher commodity prices, or you have something like retail come in, given to your point that the dividend has to be sustainable, we'll evaluate options, whether it's share buybacks and the like. That's where I view those coming in, is where you have, significant increase in commodity prices, or dispositions where you see you've got enough headroom on the balance sheet. So we'll balance all of that. But for me, sustainability is in that mid-50s range. You're growing margin, you're returning cash to shareholders, and you can compound the growth or compound the margin growth for shareholders is where we're thinking about it.
So when you think about the 5-year plan that you've got in front of you, is the right way to think about it that a higher dividend would have to be a function of either a meaningful lift in crude prices the next couple of years, or a successful closure of retail? Otherwise, you start to put some pressures around sustainability. But when you get out in year 3, 4, and 5, dividend growth feels much more doable in a flat price environment.
So number one is we look at the program this year. We've got the 2 spruces coming on, so that's 20,000 barrels a day. And I'll round 29.1 to it's a little under 10,000. We'll call it 10,000 barrels a day production by the end of the year. We hit a free cash flow inflection point into next year. And so where retail comes into that, and commodity prices is, look, we can cover the dividend now, and with what we're executing, where something like retail comes in, it would, depending on the time frame, give you a little bit confidence to, look at options in advance of that free cash flow pivot point in 2021. Which is where we really see the growth in the free cash flow as you're bringing on that near 30,000 barrels a day at the end of the year in the offshore and in the thermal assets. So, and then we would see, as we continue to bring on margins, lower our op costs, is continued. I view it as a potential to expand the dividend over time. And really what retail and others provide in the commodity prices is, could provide us an opportunity to potentially look at advancing some returns to shareholders in advance of that free cash flow inflection point next year.
You've got a great slide where in your slide deck where it shows your cash flow growth that should come through, assuming the plan gets executed on through 2023. And obviously you can see that there becomes a large buffer of excess free cash. If somebody asks you, what's the minimum amount that you would repatriate back to people in some form of a return of capital, a buyback, a dividend growth, Would you answer that question?
We won't get into specific payouts and targets, but what I will say is our focus on that is not looking to fill it with growth and further investment opportunities. Our focus is really getting that cash flow and returning cash to shareholders. So we won't say, we're going to maintain a specific percentage or we're going to return a specific percentage. But what I can say is our priority, as you see that free cash flow inflection point next year and continue through the plan as it compounds itself, is our priority is to return that cash to shareholders. And we'll balance that with where commodity prices are, where our leverage metrics are. And clearly where we're at now is we've got fairly low leverage. Our net debt to FFO on a trailing basis is just a little over 1 time. So, what that really, reading between the lines, what that gives us an opportunity is return cash to shareholders. Yeah. We won't say, give a specific, this percentage, but what I can say is our priority is not to change the capital frame.
Does a buyback seem like something that could be plausible in the context of your very large insider ownership?
It still is an option. I think it's still something that we look at, and clearly that's just a nuance, and you have to factor in a bunch of different pieces on the float and the capacity there. But I think look, if we look at our free cash flow yield over the 5 years, to your point, we hit that inflection point next year. It continues to compound. There's a good return proposition there for the corporation on the shares. So clearly that's a arrow in our quiver, and so I don't view that as a major impediment. It's just something we have to balance with everything with the tradable float. But I don't view it as a major impediment.
Questions from the audience at all? Lloyd Thermals.
Yep.
You slowed them down 2 investor days ago. If we all of a sudden get in an environment where we feel commodity prices move back to where we were at the start of the year, not what we faced in the last 3 weeks, is there any chance that you dial that back up again? Because at 60 TI, the returns on those look pretty phenomenal.
They do look good. I think we're in a good spot right now. So the short answer is no. I think we're happy with the frame, how we've balanced out the crews and how they're going through the different facilities, and we get synergies there. With where we're at, I think we're in the sweet spot, and I don't see us accelerating capital, even if you get price signals higher.
Okay. Maybe moving over to downstream, update on Superior?
Yeah, it's consistent with what we've said. So I know we went through guidance. We said, look, overall, we'd expect to, come to bring it on by the end of 2021 fully. We quoted a number of around 750 US to bring on, and within that, there's some enhancements as we go through. And so we're in progress and really in the execution, or starting the execution. We started in a little bit in Q4 and continuing through Q1. So it's steady as she goes and continuing with what we set out at guidance within that capital frame. And this year, just, the guidance that we talk about from CapEx from 3.2 to 3.4 excludes the Superior rebuild. And that's, you kind of went 400 to 500 to 450 million, 400 million. So we will execute that over the next 2 years and look to bring it on at the end of 2021. And we do expect a substantial portion of that to be covered by insurance. We've, clearly the enhancements, say they're about 100 million or so, won't be that separate from rebuild. And obviously there's always things you got to work through, and whether that's 50 or 100, but we expect that to be substantially covered by insurance, and we expect to be on by the end of 2021 fully.
Okay. Downstream, the margins in that business have seen meaningful improvements since Jeff Rinker came in and joined. Operationally changed a lot of things. They weren't all large capital investments to try to improve the profitability of the platform. Is there still incremental levers left to pull there to improve profitability, or it's more just a function of feedstock prices and cracks at the end of the day?
So there's a couple of things. So we did, you're right, it wasn't heavy in capital investment. Where we did spend our capital over the last, say 5 or 6 years was in Toledo to get it ready for Sunrise with our partner. We spent at Lima, we were bringing on the crude oil flexibility project, which takes us up to 40,000 barrels a day of heavy capacity at that refinery. And actually takes us up into higher throughput of about 170,000 barrels a day. I think back in the day was around 150, what we saw realistically. And the last bit of what I'd say CapEx, and it's not material, from a CapEx perspective, is expanding the diesel capacity at the upgrader. And that will happen this year as we go into that turnaround. And that would move it from about 6,000 close to 10,000 barrels a day of diesel capacity at the back end of that facility, which really allows us to capture. We see potential for diesel price increases, as clearly as IMOs come on. So you're right, it's not heavy on capital. Where we capture value and will continue to capture value is where there's market dislocations and volatility. So, the reason we say, our value chain is different is we have physical connectivity with optionality. So if you think about the Lloyd complex, we have coming out of there blended heavy oil, synthetic blend, diesel, asphalt. And then we've got market flexibility on what crudes go where, depending on the dislocations. And then we have different sourcing criteria into lime as well. We can source from different feedstocks and light crude in the US. So we'll balance all of that. So what really, for us now, it's focused on driving the cost down, efficiency in your refining kit, and then really capturing the volatility using our storage capacity, using that physical connectivity and changing crudes on where they go. And that's really, to your point, is where our focus is. And I do think there's value there, but it's really for us, the capture of that is coming out of market dislocations, volatility and the like, so you can start leveraging your export capacity, your storage capacity, and using that optionality.
Lloyd asphalt expansion.
Yep.
Is it on the table for continuous review or really on the back burner right now?
I think it'd be fair to say it's on the back burner. The way we've articulated that over the last couple of years, and I think it's probably the same right now. Is look, that remains an option, but realistically, with where we see things on the differential side and our balance, it's not as we've cut back growth on the upstream side as well as we maintain material balance. So it's an option that remains, and if the world ended up different where you're down to for whatever reason, which I don't believe, you won't have any pipe coming out, that's something that you could, I would say, dust off and relook at. But what I'd say is really on the back burner right now.
Market access, obviously you guys aren't challenged in that you are very physically integrated and you can clear your own barrels. But there is incremental growth that you could do within the integrated corridor on a longer term perspective. So when you think about things like TMX, if you had the opportunity to get a chunk of somebody else's capacity, would you take it today? And how confident are you that it goes forward?
Well, I think, I'll throw in another topic of, we get asked on rail quite a bit as well. And it's a similar answer there is, given our level of physical integration, our export capacity and processing capacity, anything we would look at would have to be opportunistic, and we wouldn't really want to tie ourselves long term. Because if you can look at it is what you don't want to do is outstrip your capacity on your existing assets, and if you don't need it, you don't need it, and we don't. I mean, if there was an opportunity there that we saw that was short-term opportunistic and different types of egress, we'd look at it. But given that we have the capacity on Keystone, given we have the upgrading and refining capacity in Basin, and then the processing capacity in the Midwest, anything would have to be opportunistic short-term, and it's not something that we're looking at expanding a bunch of takeaway capacity on. So, you put that as a low probability.
Mainline recontracting, obviously a very complex topic, a very sensitive topic, depending on various different parties. You can see why people hold different views. We're going to go into a hearing. Do you think that that's the most logical path for it to go forward, or what do you think the largest challenges of some of the upstream producers not supporting the idea of contracting longer term?
So I'll talk a little bit about our view, and clearly that line is useful for us. We connect to Superior via that line, and it's a source for Toledo as well. Our general view is there's a system in place that, as it works now, and we like that system, and we think it's been functioning. Clearly, depending on how this goes, that, as I've talked about, is we've got connectivity there, and we like to maintain physical connectivity. So we definitely evaluate that to make sure that our assets are connected, and we continue to get options out of there. My view, generally speaking, is I think it can become a little bit of difficult for competition, given you have people that have to source up and sign up for contracting, which I think limits the people who can sign up for capacity. My view is, or our general perception is, we'd like the system as it stays now, and we think that's the most competitive for the basin. Number one. Number two is if it is down the path of a contracted system, we'll definitely look at our options. And what I'll say is we like to maintain physical connectivity with optionality to our assets, and we wouldn't want to be cut off from connecting our upstream or our feedstock sourcing into the U.S. refinery. So that's definitely something we would consider. So, we'll evaluate and make sure our assets are protected, but our base position is this system works. It's been in place for a long time, and I think it's competitive for the basin to maintain it as it is.
Maybe just touching on M&A, because it's been a while since the attempted MEG transaction was done. You've got a lot of financial capacity and low leverage on your balance sheet. How do you think about potentially looking at acquisitions within the integrated corridor? And it's a little bit different that you guys have a more diversified portfolio, not just an oil sands company. So it's not foreign for you to think about acquiring assets in Alberta or Saskatchewan for some of these companies that have seen large dislocations in their value.
Yeah, I mean, we always go through the standard criteria. Number one, does it fit within your core area? And what that really means in the integrated corridor is can you get connectivity to your processing units? Is it low cost? Does it fit within your financial framework? And what we really mean by that is, look, it's got to be competitive on a return criteria with our Lloyd thermals or anything else within there as a feedstock basis. And it has to, and really, it has to replace that organic capital. I don't think you'll see us going at a spot, and our mind is not in the spot of doing anything inorganic. Just the thought process, if anything did come around that we would look at, would have to be low cost, fit within the framework, and not eat away at our free cash flow, so we'd have to balance all of that. But our focus really is on, to your point, the high return thermals is focused on developing those. And that really, if you look at the Lloyd thermals, they're in the gem or the heart of the company, which is Lloydminster. That integrated complex is the heart and has been the heart of Husky for 80 years. And so it'd have to be really compelling for us to look outside of that, number one. And number two is then we'd have to adjust to make sure that we're not eating away at the free cash flow for our investors.
Is it natural to think about consolidating positions in Sunrise as an example, or the Atlantic Basin if the right opportunities came up and it's just really a function of valuation at that point?
I'll start, more on the Sunrise piece. Clearly, being 50% partner and operator, you look at it as we'd be the logical buyer, and we have, commercial rights to look at that at some point if there ever were an opportunity. Like if that presents itself, we'll look at it. But again, we'd have to make sure that, look, we're going, how do we balance out that with our processing capacity, making sure we wouldn't outstrip our processing capacity, how we balance our organic capital. And so really balance out that risk. And what that really means is you're not going to be paying for any price upside. It has to be really competitive with what you could do in our existing thermal assets. So we're not in a spot where we're the logical buyer. If something presented itself, we would look at, but it has to fit within that frame I talked about. And in the Atlantic, the thing we're focused on right now, I wouldn't say it's necessarily consolidation. If you look at White Rose, generally speaking, is we're a 70% interest there. So, really not looking to consolidate that. And then if you look at where we have future, it's really in the Flemish Pass with our partner Equinor. And we've said all along that we have a 35% working interest. In actuality, it'd probably be the opposite there as we look to reduce that working interest ahead of any project sanction or anything along those lines. So, our focus really isn't consolidating at all in the offshore space.
Maybe the last one, just because we've got a couple minutes left. ESG, obviously, Canada has been an ESG leader for a long period of time. Most companies have spent a lot of time, especially larger companies, have spent a lot of time thinking about social practices, environmental practices, having good stewardship on the board, all those types of things. But in the context of the accelerated conversation and focus, what gives you the most heartburn about where we're going with ESG today?
I won't say it's heartburn. I think where I want to get to is where we focus on output or intensity metrics and just really try to drive results as opposed to a lot of the political rhetoric. I think for us, if you look at it, and I think Canada in particular, if you focus on, say, SAGD assets or whatever, there's perfect synergy between environmental impact, financial performance, and the like. And if you look at what we're doing and we're talking about, okay, well, what do you lay out for, and we're evaluating, laying out intensity targets and the like, and I think that's something on the ESG front will continue, I think, to give people an idea of where we're going and that they can hold us account to over time. So we're working through that. And if you look at it, to me, it's just good businesses. In fact, we're using and piloting artificial intelligence in Lloydminster, really for our steam allocation. And early site is a 2% increase in production at the facilities we're using. You're just optimizing, getting the most out of that energy used to create the oil. So it's really, for me, it's just getting back to let's just focus on the output targets, get something measurable, and continue to execute to, and take the rest of it and have a consistent criteria and framework for everyone in the industry, and just broadly speaking, so there's consistency and a level playing field.
Perfect. And with that, we're 12 seconds over, so we'll have to cut it off there. Thanks for coming out and spending 30 minutes with us.
Thank you.